Yeah, I mean, look, I would say for most people, especially someone from my background, that is probably number one, right? You
Right.
can learn the skills. Having the capital is a totally different challenge, and I saw that with my partner, right? As mentioned, made a lot of phone calls, people I've known over the years, and I had several people say, "Hey, I won't go into business with you, but if you have a property, we would look at it, we'd make the investment." So having enough of those phone calls started to give me the confidence to say, "Hey, you know what? If I found a good opportunity." There is capital out there for that opportunity.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Enrique Huerta is a co-founder of Rockview Capital LLC. Throughout his career, he has transacted over $1.2 billion worth of investments. Enrique, welcome to the show.
Thanks. Pleasure to be here. Thanks for having me.
Absolutely. The pleasure is mine. Enrique, there are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
Absolutely, Sam. Well, look, I started my real estate career in college, actually. I needed to find a way to pay the bills. I was working at a vitamin store. In comes this gentleman wearing the nicest suit I've seen in my entire life. And I just asked that question, kind of from like the movie The Pursuit of Happiness. What do you do and how do you do it? He says, "Hey, I'm in real estate. I'm busy right now, but here's my email. Set up a call, like we can chat later." So I did just that, followed up with him. Long story short, I got my real estate license, started selling real estate to help pay for college. But in college, I took a class with a professor who ran his own real estate investment firm. And he really opened my eyes to the universe of commercial real estate. So after taking that class, picking his brain, going to lunch and coffee with him endlessly, it seems, I decided to take the plunge into multifamily. So I took a traditional route, worked as an analyst, I worked as an associate, and then I really worked my way up to a director and then a partner of a private equity firm. And after doing that for some time, just kind of the way life led me to found my own company. So here I am today, the owner of Rockview Capital, and we're very active across the Sun Belt in the United States, buying older and newer vintage multifamily communities.
Man, that's cool. I like the way you kind of progressed through that. Like that was a very, I know you didn't plan it. Few of us can plan anything in life that well. But
That's right.
it was still just one step, logical step to the next. For a lot of us, I feel like there's that, especially when you see people such as you that are like, "Oh man, this guy's done $1.2 billion in multifamily. It's like, I want to be him next." You're like, wait, no,
Wish.
I'm sorry.
I said, I wish.
Well, right. And that's my point, is that these things take time. Like there's no pill fast that you take and suddenly you're there. So I hear a lot of hard work that went into that. What was the light bulb moment for you when you said, "It's time for me to do my own thing"?
I guess there's 2 light bulb moments. One is exactly what you said, Sam. I realized like there are no shortcuts. It's a lot of hard work. All of my mentors were they were in their 40s and 50s and they were hitting their stride. And then that finally clicked and like, hey, how do I expect to be there now when it's taking them, 20 years or whatever, right? No one wants to hear it. But look, the 20 years are going to pass anyway. We all hear it and it's true. In terms of doing my own thing, I mean, look, to be honest, it's something I've always wanted to do since I was a kid. Both of my parents are self-employed. They're immigrants to this country. They kind of instilled that work ethic and values into me. And so I knew it was just a matter of time. But the light bulb moment was, unfortunately, I had a, situation, I would say, where, I was doing a lot of work and just not being compensated accordingly and treated well. And I just, I got angry, and that anger woke me up and was like, you know what, like you have everything you need. And my girlfriend told me, "You're missing one thing." And I said, "What's that?" She said, "It's just faith." And so the moment she said that, I kind of like, I think she's right. I have the experience. It's been I look back and realize how much time had passed and finally just said, there's no perfect time. I had already thought about it off and on for a while. And I just, I had a meeting with a mentor and he's like, "Yeah, like now's a really good time." And, just took the plunge, and I've never been happier, to be honest.
Absolutely. What year was that?
That was last year. So as the market reset, as interest rates started to go up, that's when I made that decision. Hey, now there's going to be, discounts, something we haven't seen in a decade. Right. And it's time to jump in.
Right. No, absolutely. And things, gosh, what a wild ride. I guess you started what a wild ride it's been in multifamily, 12 to 18 months. What were the initial pieces of the puzzle that you put together when you stepped out? Who were they? Yeah. How did you do it? What was the ordering of your steps?
Yeah, look, I think that a lot of it was taking inventory of my skill sets and lack thereof. right? And so I knew that I didn't know everything, and I needed a partner to help fill those gaps, right? So one of the first steps was just that, kind of started to make phone calls to people in my network and like, hey, here's what I'm thinking. Here's what I've done. And most of them knew me because we had worked together in some capacity. And, eventually enough people were like, hey, that's interesting. But they also said, hey, I'm not ready. Or like, hey, I'm worried about what's going to happen next. And then finally, there's a gentleman I had worked with. He's my business partner now. He said, I want to do that too. And I'm ready. Like, what do you need from me? Let's make it happen. Mm-hmm. So that was the one first step, was knowing, hey, what I don't know and where I can fill that gap. Right. And then beyond that was just setting up our systems. I mean, look, the way that I was able to transact on so many properties in a relatively short period of time was the systems we set up. Right. So I started to get everything in order, and I work on things today that a company wouldn't have to work on for probably a couple of years, right? I have all my job descriptions for who I'm going to hire next. I have all my software and technology packages, and we don't have our first employee yet. We just started looking for people to hire. So by the way, if there's someone looking to get into multi, we'd love to talk to you. But in all seriousness, we set up everything in advance, and that took about 2 to 3 months. So I spent my holidays working on that foundation. And then once the new year came, we launched officially. And so we were able to plug in, and, we're looking at about 100 deals a month right now. And we're only able to do that because we took the time to lay that foundation. I'm happy to elaborate on any of those steps, or if you have questions, we can dive a little deeper.
It gives a good framework for it. And it is the hardest, I think, part for people that result to do what you've just done, because then it's the same person. I that's like me. I go do.
Same here.
Right. When I'm doing, I'm happy. I realized that I had a meeting looking at a building this morning at 6 a.m. because the seller wanted to meet before his employees got there. And I'm like,
I love it.
I'm like 6, that's great, man. Like I'm due. I was driving home, like, man, I love just going and doing. Like sitting behind a computer drives me nuts. But without laying that foundation, like you said, you then have to, at some point you are forced to do it.
100%.
So doing it ahead of time is just so much more beneficial in the long run. It's like
I call it proactive, not reactive.
Yeah, it is.
Proactive, not reactive. And I saw that all the companies I've worked at with a year old or a decade or 3 decades, they were all very reactive, right? Which you have to be in a way, because like no one knew there was a pandemic coming. So you react to that, right? But we all know what we have to do day to day and what it takes to be successful. So if you just set up the foundation, it makes it a lot easier. I'm like, and that's where, like, Sam, I'm like you, man. I'm the deal guy. I want to be out looking at buildings, meeting people. Right. My partner is very systems oriented, and he helped me put my thoughts into action behind for that foundation.
Yep. And finding those people that can help you with that. I think the other thing that you mentioned there that stuck out to me was acknowledging what our weaknesses are. I like
100%.
I like that story too. And that's something that I think as the leaders of our businesses, the more in tune we get with what we do, the better the business will do. And the faster it will do it. It's kind of a weird way to look at that, but and it goes back. What's that book? The Who Not, I think is
Who Not How. Oh, that's a great book. Yeah.
That's something that reminds me of that as well, where it's like, hey, I need
to build a good team.
Yeah, to fill those gaps on there. So I love the idea of systems, bringing people on board. Let's talk a little bit about what you guys are acquiring and why. Tell me what your buy box looks like today.
Absolutely. So look, our typical buy box is a building with 100 plus units, anywhere between, I would say, 100 and 250 units. Call it 1980 to 2020 construction. And we take a very opportunistic approach. So other than the size and not trying to go too old in vintage, we'll look at really any market. And I mean it sincerely. Like just in the last couple of days, I've looked at properties in Phoenix, Arizona. I looked at properties in Baton Rouge, Louisiana. I looked at properties in Columbus, Ohio, North Carolina, Florida, Oregon. I mean, you name it, we're looking, because we feel, of course, there's markets that are better than others, and we're going through a tricky, part of the economic cycle right now. But at the end of the day, every market has good opportunities, right? And so I used to be very active on Bigger Pockets, the message board, and I do a lot of calls with people asking for advice. You can find deals wherever you are today, right? Like, are they expensive? Maybe, is it hard to find deals everywhere, right? So we just look opportunistically, and when we find the right opportunity, that's when we'll move quickly and act aggressively. But that's what I would say is our typical buy box today. It's a little wider out of necessity, right? Because as an example, in 2021, 2022, 2022, this part of the year, you could have 30 or 40 deals to look at in Phoenix, Arizona. Today, there might be half that. And the quality is a lot lower, right? So inventory is way down. There's not as many nicer properties that we'd like to be buying. And so we've had to open that buy box a little bit.
How do you, well, yeah. So you would say that there's half of the available properties. I would have thought, and again, we only own a couple more properties, isn't it? But I would have thought with the increasing interest rate, with just uncertainty in the market overall, that maybe more properties were coming on. Not, I'm wrong.
I think that there is, I'll just call it what it is. I think there's some denial in the marketplace, right? Everyone, there's a lot of fast money being made the last couple of years. I think everyone thinks or would hope their buildings are worth more than they are today, right? I mean, look, interest rates, again, it's basic math. They've clobbered the values, right? 20, 30% down, depending on the market. And so a lot of owners are waiting to see if things will change, right? If rates will come back down or something like that. Our thesis is they won't. We think they're going to stay higher for longer. We think the values will have to come down out of necessity and investor return requirements. And look, there's some denial. But on the other hand, I think there's also a lot of very good operators who are just like, hey, if I don't need to sell, I'm not going. Like rent growth is still, maybe it's not 20%, right? But it's flat or slightly positive. And so everyone's doing okay. The problem that we're keeping an eye out for is, people with floating rate loans, excessive bridge debt. Like a lot of deals we're seeing right now were 90% loan to cost when they were acquired last year. And those are people that, are coming to market, do need to sell. And so they're more motivated than other groups typically would be. And I think there's a little bit of shame too. Like no one wants to air their dirty laundry, right? So a lot of properties, they are available for sale, but off market. So that's what we're focusing most of our time on, is finding those off-market opportunities.
Yeah, that's really, really smart. I like the way you've put that. Let's talk a little about, obviously you've got a long track record before launching out on your own, but one of the things that people commonly struggle with when they go to scale their business, having the capital back. How have you guys solved that?
Yeah, I mean, look, I would say for most people, especially, someone from my background, that is probably number one, right? You can learn the skills. Having the capital is a totally different challenge. And I solved that with my partner, right? As mentioned, made a lot of phone calls, people I've known over the years. And I had several people say, hey, I won't go into business with you, but if you have a property, we would look at it, we'd make the investment. So having enough of those phone calls started to give me the confidence to say, hey, you know what? If I found a good opportunity, there is capital out there for that opportunity. But then I had even an even bigger blessing with my actual business partner. So my business partner, that we're in business together today, not only does he have an amazing experience with systems, with real estate, with other industries, but he also has access to significant capital through some friends and family relationships. So we're headquartered in Beverly Hills, California. And I would say in any given week, once or twice a week, we're just having meetings with those friends and family, continue to educate them on what we do, garnering indications of interest and going from there. And I would say, we don't have a fund or anything like that. But once we got to the point where, at least verbally, we were like, hey, we have about, $50 million in that, of access to, that gave us the comfort to take that next step. And before that point, because you know how it goes, right? People say, hey, I'm interested, but not everyone moves forward, right? So you always have to give yourself some buffer, right? I mean, our average deal will probably require $5 or $10 million of equity. So when I had enough indications of interest for 10x that's when I was like, okay, there's some built-in buffer and contingency here. So let's get after it.
Right. Yeah.
I'm pretty conservative. I'll be honest.
Yeah, even if it's 5x at $10 million an X, still a pretty healthy buffer. And we think we all know in the capital raising business, lots of people raise, and then when it comes time to write the check and act fairly high.
Exactly.
So it's
exactly.
That could be for a variety.
And with the backdrop today, yeah, exactly.
What were you saying now?
Oh, I was just saying, especially with the backdrop today, Sam. Like, look, if this was pre-COVID, I probably wouldn't have waited that long. But just with everyone kind of being squirrely about a recession on the horizon, layoffs, that kind of thing. I mean, look, a lot of our investors are in tech. A lot of them are in real estate and finance. And these are the sectors being hardest hit. So many of these people, I don't want to ever depend on a handful of people, right? I want to have diversified and just some more certainty. And that's how we approach that. Most people approach it like, again, reactionary. Oh, I found a deal. Like, where can I find money? No. I was like, hey, here's what I had a business plan. I had a nice deck, everything like that. Here's what we're doing. Like if I was any other type of company, like if I was looking for VC funding, like here's what I'm doing. What do you think? Oh, I like that. I'm in maybe around this much. And enough of those people, that's when we were like, okay, let's go ask brokers and owners for deals.
Right. No, I love it. I love it. We talked a little bit about your buy box. You said you've opened it up some. One of the things I think that you and I talked about before we kicked off the show was your desire to acquire new construct product. And I don't know if we talked about that much at all. And even going to developers that are developing. Can you give us the playbook you guys are thinking through on that front?
Absolutely. I think it's pretty clear in a couple levels. One is everyone likes nice, new, shiny trophy buildings, right? So that checks a lot of boxes from just a aesthetic and attractive portfolio perspective. Number two is, with cap rates where they are today, I mean, you can basically find a brand new building at the same cap rate, plus or minus 25 basis points as you can in older 70s or 80s vintage property. So if I were to look at, ignore the age and everything like that, and you just look at the returns, they're pretty similar. But then you take a step back and you recognize, well, hey, I don't have to renovate this building. There's nothing I have to do here for 5-7 years, right? My employees at the property management level are going to love managing this versus this that may be full of problems, maybe full of outstanding evictions, have delinquency issues, things like that. And of course, it doesn't come without its set of issues, right? There's a lot of new construction right now. So you're going to deal with some heavy concessions, maybe some extended vacancy and things like that. But we put that all into our underwriting. And so all things being equal, I just think that our vision for the future is to be a core plus investment manager. We like to have newer buildings. And so we just are saying, hey, why not start now? Why wait? Why buy ugly ducklings if we can buy, the nicest property we can? And so from that perspective, we're just going direct to merchant builders in smaller markets to see if we can get those opportunities.
Is part of that strategy wrapped up in that the development timeline, let's call it 24 to shovel in the ground to now they're giving away concessions and things just so they can fill the building. But
that's right.
The market has shifted, and maybe I'm saying too much here. Maybe I'm projecting, but as the market has shifted, and as interest rates have risen, their ability to then implement their full value or their full business plan of buy it or build it, lease it up, and then resell it for X, maybe their margins are getting compressed.
That's right.
Yeah. And so then there's even more impetus for them to go ahead and hurry up and offload that property. Is that kind of on that front as well? 100%.
I think a lot of builders got really aggressive over the last couple of years, and they thought they were going to refinance out their construction loans at 4.5%. We all know that's not happening. And anything for existing product that's stabilized, you're probably closer to 5.5, maybe 6. And if you need to do another construction loan on top of what you already have, I mean, you're talking 10%, right? Or if you need gap funding, like a mezz piece or something like that, 12%. And so a lot of these builders are no longer able to get that financing. And so we're actually being approached by people before they even start lease up.
Wow.
Like, hey, they haven't even received their certificate of occupancy. They know they're in for a rough winter, so to speak. So they're like, hey, I'm not going to make as much as I thought, but I would sell it here. And then I take that risk off my book.
Right. Yeah. How do you underwrite? That's a stupid question, but I'm going to ask it anyway. How do you underwrite when there's I guess you just pull comps and say that's it is, or is there another?
Yeah, no, I mean, look, I think it's like everything else. I like to keep things as simple as possible. And it's exactly that. Like, hey, building, what are all the comp? And then you have to, if you're conservative, you have to factor in the fact that rents might be declining a little bit, right? Historically, they haven't declined significantly, even during a recession. But just understanding like, hey, if I thought I was going to get, $1,800 a month, maybe it's only going to be 16. And so just being conservative, underwriting more concessions, underwriting extended vacancy, like all that will help. And then look, we lean on a lot of our lending partners, right? There are agency loans available for these kind of lease-up construction opportunities. So we go to our lending partners and we say, hey, we like this building. Here's what we think. Can you run it through your comp set? Let us know. If they're comfortable with it, they feel they can get it financed. That gives us the confidence to move forward. And then the other piece, honestly, Sam, is just our equity structure. Most of our investors are long-term family office style investors. And from that perspective, they're comfortable holding buildings for 10 years.
Yeah, no, that makes a lot of sense. Yeah, depending on what the capital needs, for the people placing. But
you're excited just like I am, man. I like it.
Absolutely. Enrique, this has been a blast. Thank you for taking the time here to come on today. I think maybe you had mentioned that if you had a message out there that people wanted to hear that are looking to get into the space and you wanted to share that with them, what was that, if you recall what it was?
Yeah, well, look, we're a newer firm, right? But we're well capitalized, good opportunities across the country, and we're in full growth mode. So while other companies may be, shrinking or shying away from the current environment, we're embracing it. We're going right into it. And so from that perspective, we're looking to hire some new people, right? We are looking for like a financial analyst, asset manager. I don't know if they have to be in LA or not yet, so we can talk about that later. But we're looking for good talent. And of course, we're looking for good opportunities. So if there's any investment sales brokers or owners on the line here, we'd love to hear from you. I can be reached, at Enrique, Enrique, at rockviewcap.com. That's my email, and then my cell phone is 949-751-7079. If anyone wants to call, text me, whether you want to apply or just talk shop, I'm always available.
Awesome. Enrique, thank you again for your time today. I certainly appreciate it.
Thank you, Sam. It's been a pleasure. Have a great one.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.